Well, Larry Brilliant has just talked us through some of the epidemiological issues that are posed by coronavirus, and he's talked with broad range about a variety of other subjects. And I'm sure that Ed Hyman is going to take us through some of the potential economic effects that can come from coronavirus, pandemics, and other things like that. Ed has been the #1 economist on institutional investors' list of Wall Street economists for something in excess of 35 years. It may be 39 years. He is just that good. He does not come out and speak very often. He does not come on CNBC very often at all. It is a real treat for me to bring up on stage Ed Hyman. Ed, come on out. The floor is yours. It's great to see you.
Good to see you, sir.
Fantastic.
How you doing?
It's all yours.
Well, this is a heck of a day. I came down here thinking I was going to be meeting with maybe a dozen people, and then I began to realize it's a lot more than that. And I looked at the program, and it blew me away. The world champion accordion player, and I see Norman Lear here, who's 97 and not retiring. So it's a heck of a group, and this is a heck of a day to be here from my vantage point, and I look forward to sharing with you some of the things that I see going on. As you probably know, the S&P is down like 100 points today, if I have that right. And bond yields are down 10 basis points. So we started out talking about the coronavirus, and that's exactly what is impacting the markets today. It started with Italy over the weekend, where there were a number of new cases and deaths, and they quarantined 10 cities in the northern part of Italy, which is where all the manufacturing is. So it looks as though this could come here. This could be one of the last times that you and I come to a big conference like this for a while. Flying is going to be an issue. Going to restaurants could be an issue. But from my vantage point, we just have to wait and see if that comes here or not. So far, it really hasn't. But I'm on the edge of my chair, and I'll, in a second, tell you what I think needs to happen to cope with that. I want to show you a slide which is not showing up for me. Is it showing up for you? Good. So we survey about 400 or 500 companies a week. Same companies, the same person, usually the CFO, and ask them how their sales are. We happen to have 21 companies that do business in China, and I thought this would go to 35, which is about where it was in 2009 and 2016, and it went through that like a knife through hot butter last week to 33. It went down a little bit more last week to 32, but this will be my main way to see how much the coronavirus is impacting China, and it is impacting it a lot. I'm going to move forward here to inflation. There doesn't seem to be any inflation. This is a measure of not prices, but of the way you and I feel about inflation. It's a survey of consumer inflation expectations. And last Friday, it fell to a record low of 2.3% for the first half of February. And on another score, this is from the purchasing managers. They have services and manufacturing, and that's also low in February. And this morning, when I was getting ready to come down here, they had inflation for Singapore, which is not on the front of your mind right now, but inflation there was 0.3 year on year overall for 12 months. So that was I just wanted to make that point first, because this is now front and center. As I mentioned, bond yields are now down 10 basis points today. They're down 30 basis points recently, and you now have an inverted yield curve. It's about 20 basis points. You're 135 and 155, 135 on the 10-year, 20 basis points, 155 on the 3-month. So when I did this just a day ago, it was 15, or maybe even 13. And so the point I want to register is that given the seriousness of the coronavirus, the Fed is under pressure to cut interest rates. And I think the stock market is going to be under pressure until they do that. And I think they might do it as soon as March. This is all brand new for me. I don't know if it's brand new for you. But I wanted to show you the inflation first, because they're not held back by worrying about inflation by cutting too much. But I don't see any weakness right now in the economy, but the coronavirus, I think, could be a real factor. In thinking about what's going on, I want to show you this chart of global short rates. These are emerging as well as developed. And you can see where SARS happened back in 2003. Global short rates were coming down. And if you could maybe try and take a mental picture of this, they went up and they peaked just before the recession. I remember in 2007, when the Fed last raised interest rates to 5.25, going, this is insanity, because at that point, housing was already weakening significantly, and yet they made that last move up. At this point, when the coronavirus is hitting, the Fed has already been easing, or central banks have been easing for over a year. This includes, as I mentioned, emerging as well as developed. And on the emerging side, which you don't get to see as often because it's not in the news too much, there have been almost 90 cuts by emerging market central banks. So moving to the U.S. economy, I mentioned at the beginning that we survey companies that do business in China, we do business in Europe, and this is the surveys that we do for the U.S. These are retailers, home builders, truckers, banks, and as of last Friday, which is just yesterday almost, the surveys were still holding up. There's no evidence, and that, if you can see, the level there is pretty high compared to history. So I think the economy right now is growing something like 2.5% when this is hitting, in part because the central banks have been easing. These are some other more traditional data. The top chart is consumer confidence, which is off the chart, frankly. And the bottom chart, are housing starts, which in the past 2 months have just skyrocketed. They've been 1.5 million. It didn't look like they'd go to 1.5 million in the entire cycle, and now they've moved up there. So I'm showing you this to sort of warm you up for this slide. About 4 years ago, I started noticing when I was traveling that places I was going to were doing really well. As of now, I've found 96 cities that are doing well, and 4 years later, a lot of them are booming. So the unemployment rate here in Naples is 2.5%. I don't know if you would agree with me that Naples is doing well, but it certainly looks like it's doing well. And I was in Salt Lake City last week. One of the guys I met with said that house prices in his neighborhood had increased 40% in 3 years. And the guy who was driving me around, I got in the car, and he said, "Oops, I'm sorry, Mr. Hyman. I was on the phone. I'll cut it off. I'm a real estate agent as well as being a driver." And of course, this they hit me right away. Everybody was a real estate agent at one point. But every place I was in Atlanta last week, and it's now these places, they're not doing well, they are booming. And so I've never seen the U.S. economy doing this well across so many places. I'm not saying it's fast, but I'm just saying there are many, many cities that are doing well, and I've studied them, and these are the things that are making them do well. One is entertainment, and a place like Naples is sort of a destination, fits with that. You have the movie business in Atlanta. You have sports teams. Entertainment has become, 40 years ago it wasn't a big deal. Now it's a huge deal. Another thing is healthcare has become a big business. I'm sure it is here. It is in New York. It is in Boston. Nashville is a good example of a place where there's a lot of healthcare industries. And then you have higher education has become, every time you find a place that's doing well, like Pittsburgh, there'll be a school that's generating kids that are coming out. And so those are the new things that are driving local economies, and they're not the normal manufacturing jobs that we had in the past. But I'm trying to lay this up when I think about the role that the virus might have, that I think the U.S. economy is doing as well as I've ever seen it do. These are a couple more examples. The top chart on the left is employment in South Korea, and then employment in Singapore. And I have a bunch of other employment numbers, but employment is strong everywhere. So more so than a lot of my colleagues, I see a lot of strength globally, like in employment and in the U.S., in our company surveys, or when I travel around. This is a chart of the OECD Global LEI. I don't know if you have a picture in your mind, but I showed you global short rates earlier on, and they'd come down a lot and for a year, and now after they've come down, you're getting a little upturn in global economic activity. So this pandemic is occurring when central bankers have already been easing and the economy is already turning up. I don't know how bad it's going to get here, but I'm not counting it out. I'm looking at it square in the face. On this one, we'll find out soon enough whether this is right or not. In 1959, Alan Greenspan gave a speech. He says, 1959, he says, the stock market drives the economy. And Bernanke, when he was trying to defend quantitative easing in 2007, said we do quantitative easing, it drives up the stock market, and that drives up consumer spending. So we're going to find out soon enough whether or not this big increase in the stock market we've seen over the past year, which has lifted consumer net worth along with house prices, it's up 10%. We're going to find out whether that will help the economy improve. Now, if the pandemic comes in and impacts the economy, this will soften it. So I might not be able to test it, but at the moment, I'm thinking the economy should improve in 2020. I'm thinking as I'm walking here, there's another thing that's impacting the market, and that is the upcoming political election. And to the extent the economy is weaker, Sanders would have a better chance of winning, or Trump would have a harder chance of winning. So it's going to be very interesting to see how the Trump administration handles the pandemic if it starts to come here. Are they going to quarantine cities? Holy smokes. So stay tuned and see if this supports the economy like I think it's going to. Warren Buffett's all over the news today, as you've seen. And he is be fearful when people are greedy, be greedy when people are fearful. And I buy that. And then Sir John Templeton has the phases of the stock market from greed to fear. And Howard Marks, who I'm a big fan of, in his latest book, He says there are 3 keys to investing. The third key is to know whether or not people are bullish or bearish, and then go the other way. So I just wanted to lay that out and show you this chart. The red line are people putting money into bonds, which they've been doing, and the lower line is what they've been doing with the stock market, which is basically not a lot. We survey hedge fund managers every week, about 40 of them, the same ones every week, and ask them how they're positioned, and they're defensive. I was at 2 of the biggest fund complexes in the past 2 weeks, and they told me that inflows were pretty good, but they're all going into bonds or defensive products. So my view is that the investors, you and me, are still pretty much glass half empty for, frankly, lots of good reasons. Like, we're 11 years into the upturn, valuations are pretty high, the stock market is over 3,000, you have the problems with China, you have the election coming up. That's enough. But I'm saying, with the monetary policy and with people pretty defensive to begin with, I am frankly sort of looking up, except for this problem I have right here and now with the pandemic. You may know this, but if you don't, let me share it with you. Australia hasn't had a recession in 28 years. Now, there are 2 things that they have going. One, they're close to China, and 2, if you know Australia, they've had a huge increase in immigration over these years, which has helped keep the economy going. But my feeling right now is that the odds of a recession in the U.S. are pretty slim. I wouldn't say another 11 years, but I'm just sharing with you that I think this expansion could go on for a long time. And my experience tells me that the end of this expansion will occur under 1 or 2 or a combination of these 2 things. 1, inflation picks up. So far, that hasn't happened. Second is you might get a bubble in asset prices. And you and I have to judge whether or not that's already happening. I don't think it is. But you could get a combination of those, but you could have possibly no inflation. But if the S&P goes crazy, you could get a bubble that would then fall on its own weight. The last thing I wanted to share with you is this fun slide I hadn't seen before. This goes back and looks at previous big moves in the stock market. We have gold, Nikkei, Thailand, technology in the 90s, U.S. housing bubble, and then we have this monster. So I'd like to get you to think about whether or not we're seeing something in the technology sector that has never happened before. I'm talking about Microsoft, Google, those FANG stocks that have been driving the stock market and reflecting what's going on in the economy. So if we're seeing some sort of huge explosion in technology that's impacting our lives, one thing it does is it keeps downward pressure on inflation. It should be good for productivity, and it should keep the expansion going longer and longer. So those are the main things that I wanted to cover. I'm sorry I had to be down here today when this virus is breaking out, and frankly, as I mentioned, I think it might continue to build. So far, it hasn't showed up here in the States, but if it does, we'll know about it very quickly. I put a marker of 100 cases to indicate that we have the same sort of thing that Italy has going. And if that happens, then the next thing that has to happen to keep the stock market on an even keel, not going down anymore, is for the Fed to cut interest rates. So thank you very much for your time. Hope this was useful. I would say see you next year, but not sure.
Ed, thank you so much.
Okay, sir.
It's great to see you again.
Nice to see
Thank
you.
you very
Nice to
much.
see
I was
you.
really
Okay.
really enjoyed that.